So super duper welcome to everybody. This is day 2 of our market temperature webinar. So yesterday, if you joined us yesterday, we talked a lot about a technique that I personally use in all my trading to help me, really find good risk on, risk off markets and how that translates into the currency market. Today, we are going to talk a little bit about how to put all that stuff to work, right? I want to talk about some of my favorite trading opportunities in relation to that, how I'm going to manage these positions and how I'm going to kind of do everything. So I'm pretty excited to talk about that. We're going to have a little recap of what we talked about yesterday, just a short one, because I know that many of you on today were on yesterday. So I want to make sure that we don't cover too much of the same material, but I'm gonna have a little, we'll spend probably 10 minutes just recapping a couple of things, so we'll get right down to that. Okay, so welcome everybody, so happy to be with you today. Let's talk about just, excuse me, a favorite topic, which is how to really see what these markets are up to. One thing that I have noticed like crazy is that it's so easy to miss a huge movement. And what our goal is to not miss huge movements, right? We don't want to do that. We want to be 100% prepared for these huge movements. Okay, so let's talk about it. Let's see how it's all working out and what's going on here. So again, the goal will be to find out, how the big funds are staying on the right side of the movements, right? And how we can put that to work with some very super specific charts that I want to trade, some trades that I'm in, some trades I'm trying to get in, and so on. It's going to be awesome. Sure. Yes, Greg. Yep. We'll talk about the Dow, S&P, all that stuff. Yes. Fix. I love autocorrect. I was trying to text my wife earlier. She sent me a cute picture of my two daughters playing, and one's 7 and one's 1, and I kept trying to. So my youngest, my little 1-year-old, calls the older sister Lala. Her name's Stella, and she calls her Lala. And I was trying to type in, oh, look at Izzy and Lala, and it kept typing Papa, and for like 5 times, and I kept sending these text messages, and it was terrible. It was just one typo after the next. I'm guilty. All right, guys. So we're going to talk about how to put all this together. So for any of you that were not with us last night, again, this is a picture of me. This is who you're talking to, Jared Johnson and crew. So that's me and the family. Happy to be with you guys. One thing that I'm always sad about is that I don't get to see most of your guys' faces. I've talked with many of you many times. I've seen, we've done video chats and so on before with some of you. But I really like to get to know everybody, and I love to just have a good old face-to-face, even if it's a face-to-face with the just over the camera there. Oh, okay, we got user getting pretty excited over here. That's excellent. That's super excellent. I think we're gonna send Mr. User down here by the wayside. So adios, my friend. Enjoy. Oh, we got some characters. Someone loves Minnie Mouse here. Yes, we love a little Minnie Mouse. We love Disneyland. We go to Disneyland quite extensively, so we're definitely into that whole situation for sure. All right, guys, so I'm Jared Johnson, founder of Day Traders FX. Been doing this for a long time. I always say 15 plus years because I think my math is not so good. And so it's probably been more than 15 years. I think we're creeping up on the 20-ish year area, so it's pretty exciting. And it's been an awesome, fun experience trading, and I've loved doing it. And I've done it with many of you for a very, very long time. You guys have been in my trade groups and been in my webinars and so on for many years. It's been super awesome, so I've loved it. Okay, guys, so again, the goal today is to put what we have learned yesterday, and if you haven't learned yesterday, or excuse me, if you haven't watched the webinar from yesterday or weren't able to attend, it's in your email inbox. It's there for you to have a look at. We want to put all this stuff to work, right? We want to get some dollar bills that we can pick out of the thin air, out of the sky here, and start to really implement some of this stuff that we're learning. Because as we talked about yesterday, it's very nice to know, and it's very nice to want to put to work things, but if we don't make decisive action and just actually start doing things differently, then all the stuff that we learn is not as useful as it could be. So that's really what I want to talk about today. I want to talk about how to implement everything that we talked about yesterday. So we'll get right down to that. It's going to be very exciting. Okay, so our goal here is to really take the divide, to separate the facts and the myths, right? So what do we think is happening and what is actually happening, right? Now, keep in mind, I'm kind of like the tech support guy for whatever company, or I'm like the guy that works at the restaurant, right? You know, you talk to people that work at, you know, whatever restaurant, you say, oh, it's my favorite restaurant, and you talk to somebody that works there, and you say, do you still eat here? And they're like, heck no, I don't still eat here. I see this food all the time. I can't eat it. So I'm that way in the aspect of, I talk to traders every day and I see what people are doing, and it's actually very encouraging and it's very exciting for me, because even though I see a lot of the ugly things that happen, right? I see people that get stuck in certain cycles, right? And these are very common cycles that people get stuck in, where they're losing money, they can't get out of it, it's discouraging, so on. And to be 1000% honest, I feel for those that experience that 100%, because I was there. I have no idea how I stuck with trading for, you know, some of the major downs that I had early in my trading career. But it's discouraging and it's hard. But what I'm saying is, the great thing about the fact that I talk to traders all day, every day, and I do a lot of consulting, and I do a lot of teaching, and I do a lot of webinars, and I manage money, and I do everything trading related, is that I see that most people make the same 2 or 3 mistakes, which is awesome, because that means it's easy to fix. I think that sometimes for those out there, trading can feel like it's this really intangible thing that you can't really pinpoint where you're messing up or where you're falling short, because it's just a little bit here and a little bit there, and so on and so on. And it's not really the case. It's actually very simple. You know, I'll tell you, I did a trading psychology webinar not too long ago, a couple months ago, where I talk a lot about that, and you guys should definitely have a little peek at that, because it's really good stuff. So sift through your emails, you'll find it in there. But you know, where people get trading wrong most often, number one is trying to go too short term. It's very difficult to go too short term. It's not impossible, but it's very difficult. So that just makes our trading more difficult. It makes things more difficult. Number two, we don't have a solid system, right? We just are guessing, and guessing is terrible. And the whole point of the webinar today and yesterday is to stop the guessing and start doing the things that actually really work. So, and honestly, it's pretty easy. Number 3, number 4 would be trading too large and trading too frequently, right? Not being patient. And so when you take those kind of 3 or 4 things out of the equation, and you work on them and you learn to fix those things, trading is actually pretty easy. It's not that difficult to stay profitable, to find good trades, and to do consistent, profitable, fun trading. I talked about it a lot yesterday. I said we gotta bring the fun back in trading. I think a lot of people get stressed out by it, and they get too, you want too much action and so on. Trading is a very steady, very easy flow kind of a thing. And once we get into the flow of it, we stop guessing, we stop trying to trade too large, we stop trying to have a home run hit constantly, and we patiently wait for our setups. It's easy going. I've told members of my trade group many times before that if I feel stressed about a trade, I'm not okay with that, because because I know I'm doing something wrong. I'm kind of tapping into one of those four things and I'm getting it wrong. And I don't want to do that. I want to stay with what works and with what feels, in line with my strategy. So so that's kind of what we're talking about here. And when we're trying to really separate our opinion from what's actually happening, I mean, the thing that I hear constantly is the market's too high. And I always say the market's too high compared to what? Compared to the other market? The S&P is too high compared to the S&P. What is too high or too low compared to what, right? So we have to start to take our opinion out of things and start just looking at what is actually happening. One of the favorite things I hear a lot of is, this should go up. The dollar's going to crash. Stocks are going to crash. One of my favorite ones, I heard everybody contacted me, because I've got a lot of traders that I work with. I've got thousands of people on my email list. I swear I got so many emails and messages and so on. Cannabis stock. Who's in on the cannabis stock? That's the biggest opportunity. That thing's going to go nuts, cannabis stock. And what did the cannabis stock do the whole entire year? Nothing. Well, it actually did something big. It went down. It went down hugely. Cannabis stock did terrible, right? And so we're all trying to decipher this opinion versus what's actually happening. So we're going back to facts versus myths, right? Facts versus myths. And so I really want to keep us on that track. And so I think that very funny, Chris. I like it. Good stuff. I very much think that we can decipher the noise of the news and of all the talking heads out there, and we can just get right down to the facts, right? And so the facts for me, for the most part, are a couple of things, right? Technical analysis. We talked about this yesterday. Technical analysis has to be used. If you do not think technical analysis is important, I don't know what to tell you, because I would disagree 1,000%. So we've got to use technical analysis, but people talk to me a lot and they say, what's better, technical analysis or fundamental analysis? And I always say, yes, absolutely, 100%. And because we have to use both, right? We have to use both. And that's what we're going to talk about today. But we're going to talk about how, the important role that technical analysis plays in this fundamental analysis side of things. So let's be friends, technical analysis and fundamental analysis. Now, again, when we're talking technical analysis, we're just talking the basics here, right? Identifying trends, identifying channels, patterns, support, and resistance. We're not going crazy, folks. We don't have to go crazy. We don't have to go nuts on those details. We're just trying to cover the basics. And so that's what we want to see when we're talking technical analysis. Now, on the fundamental analysis side of things, we want to make sure that we're looking at this, right? We're looking at numbers. We're looking at market sentiment. These are all very important things. I love this chart because this is so accurate to, or this graph, excuse me, this is so accurate to what we see in trading constantly. Market's going up, right? There's some optimism. Everybody's getting excited. Everybody's talking about it. And usually right around the top, there is absolute euphoria, right? I've had people come to me and say, hey, stock market's up quite a bit. I think it's time to buy. And I'm going, okay, that was kind of the signal I was looking for, that it's time to sell. We're entering euphoria stage where people that didn't even know a stock market existed are starting to say, hey, how do I get involved here? And so it's very interesting to kind of look at this sentiment and mix it with the technical analysis side of things. And I am looking at numbers. We're not going to talk so much about all the numbers, as far as news and some of those driving factors. I'll tell you guys out there, fellow currency traders, that the only numbers that I really look at and or care about are interest rate, and not even so much interest rate numbers, because those are not even reacting so much to what we would expect. So, I'll look at interest rate numbers. I look at elections, that kind of stuff. And, the rest of the news is really, really kind of ski-wampus a little bit. But this sentiment is so important. This is so important right here. And this is what we've got to learn how to read. And that's those are the charts that we're talking about today. Who knows what the yield curve is? Anybody know what the inverted yield curve is more specifically? What's the inverted yield curve? I've got a chart right up here for you guys. Inverted yield curve. Anybody? Any takers? Any takers? Anybody know what that is? Who can show their trading prowess here? Inverted yield curve. Anybody know? I'll just let you take your time. Take your time. I actually really want to know if you guys know what it is, because I'm not sure what it is, but I've heard it's interesting. So no, okay, all right, we'll talk about it. Yes, yes. Hey, Sharon, good to see you. Good to see you. Volatility. Yep. Okay. Okay. Let's talk about the inverted yield curve. Oh, there we go. Sim, my man. Good to see you, Sim. Glad you can make it in there with us. When long-term yields are lower than short-term yields. That's right. That's right. So that's what the inverted yield curve is. So that's what, you know, I'm sure everybody heard about it like crazy in August, September, you know, July, August, September, kind of in there, we heard a lot about the inverted yield curve. And it just means exactly what Sim said. Long-term yields, you can see this purple line is our 10-year. Usually it's 10 and 2-year, or 10 and, 3-month is really short-term, but it's where that long-term yield gets lower than the short-term yield. And what that means is long-term growth is looked at as slowing and terrible, and we have a safer bet with the short term, right? And so then that usually kind of creates this whole a recession's coming and so on, right? Because oftentimes an inverted yield curve has preceded a recession, most every time since the 1940s, really. But we have to know other things, right? This is just one more of those things that we can say, what's the market sentiment, right? How are we looking at this? And so yield curves, or just, Treasury yields in general are so important. They're so important. Yesterday we talked briefly, we talked more in much more detail and in depth, and we'll talk briefly about it today, how we're going to use the VIX, stocks, bonds, and yields to find some of my favorite trading opportunities of the next, I don't know, 3 to 6 months, probably somewhere in there. How we're going to use these 4 instruments to find some awesome trading opportunities. Super excited about this. Okay, so we're going to do that in a couple of different ways. So Greg was asking a little bit about going over VIX, stocks, bonds, and so on again, and we definitely will. So this is good stuff. So remember, whatever order you want to look at these in, doesn't matter, right? Doesn't matter. Just make sure you do your analysis on these. If you look at the VIX first, fine. If you look at yields or bonds first, fine. Doesn't matter. Doesn't matter what order it's in. Just make sure you look at these, do the analysis, and then step back and get a look at the big picture. So just a quick recap here. Okay, perfect, Greg. All right, excellent. Glad I answered that for you. And again, the order is just as long as you get the 4 in there, that's all that matters. So very good. So the VIX, this measures volatility and investor sentiment, AKA, are people freaked out or are they confident, right? Are investors buying like crazy or are they not buying like crazy? And stocks, referring to stocks in particular. Okay, everyone good with that? VIX, investor sentiment, and volatility. S&P, right? Dow, etc. We're looking at indices because we want to see, for the most part, the S&P chart and the Dow chart and the NASDAQ and everything else is going to look pretty similar, right? They tend to go up fairly well together and go down fairly, succinctly. And so if investor sentiment is strong, the market goes up, right? And for investor sentiment to be strong, we need the VIX to be low. We're talking about bonds and treasuries. The number one chart that I look at is TLT. If investor sentiment is up, bonds are usually down because bonds are considered a safe haven type investment. And so this is a very strong, and there's a lot of things to talk about with bonds as well, about how they react to short and long-term interest rates and so on. But for the most part, and for the purposes that we're going to be using and talking about today, we're going to focus on the fact that bonds are usually a very safe haven investment, meaning that if investor sentiment is low, if the VIX is high, stocks are down, bonds are typically going to be up, and vice versa. If the VIX is down, stocks are up, bonds will usually be down, because money will transfer into bonds when there is lack of certainty, lack of confidence in what's happening in the broad-based market, right? So it's like putting your money in bonds is kind of like pulling your money out of the bank because you don't trust the bank and you're putting it under your mattress, right? That's kind of what bonds are. We're saying, hey, I don't know what's going on with this bank. These guys might go out of business for all I know. I'm pulling my money out. I'm putting them in a safe in my house. That's kind of bonds, right? And so we're able to kind of see the flow between the two things. The stock market's rip roaring, going strong. Typically, bonds are not doing so well because nobody wants to be in a boring bond. Nobody wants to be, having your money making the least amount of returns, right? Again, if bonds are like putting your money in a metal box under your bed, then the stock market can be like investing in Bitcoin in the beginning of 2017, right? Or whatever that was. I think it was 2017. Yeah, had that big, huge run up. So, so we have one that's really risky but can give us really good returns, and one that's much more stable and steady and gives us much lower returns. And those are bonds. So this is how we're going through this investor sentiment, right? Yields are the interest we earn for owning bonds and treasuries, right? You buy a bond, a 10-year bond, a 20-year, a 5-year, a 2-year, whatever. This is how much interest you're going to make. And so this number moves opposite of bonds. If bonds are up, yields are down. If yields are up, bonds are down, right? So it's a pure supply and demand kind of situation. If bonds are going up, everyone's going to buy them anyways, and they don't get paid as much money because there's huge demand for them. If bonds are going down because everybody's putting their money in riskier places, then those yields, aka what you make from owning a bond, will go higher because they need to entice you to buy this boring, safe investment, right? So we talked a little bit yesterday about how a good balanced portfolio has stocks and bonds, right? One's really risky and really crazy, and one's very not risky and very stable. And so we have to kind of have that to keep everything going. So then that will create this risk on, risk off market for us, right? Investor sentiment is bullish. It's a risk on market. And those four charts were kind of those four things we just talked about are what tells us if this investor sentiment is bullish or bearish, right? So risk on is VIX is low, stocks are high, bonds are low, yields are high. And I'll have another chart here. And risk off, same thing. So risk on, low VIX, high stocks, low bonds, high yields. Risk off, high VIX, low stocks, high bonds, low yields. That's risk off. Now, how that all plays out for us in the currency market is, and we're going to go look at these charts. We're going to spend most of the time on the charts here. But how that reacts to the currency markets is typically in a risk-off market, we see strong Swiss franc and we see strong Japanese yen, and we typically see the weak Aussie and New Zealand dollar movement as well. And vice versa. If it's a risk-on market, the stock market's cranking, it's doing great. Japanese yen, weak. Swiss franc, weak. Aussie and New Zealand, strong. Yesterday, a few people asked, why don't we have the dollar in here? Why don't we have the CAD in here? The pound, the euro? Because those don't react in such a way. The euro is kind of, I would say that the euro is kind of like tofu. Whatever it's cooked with, it tastes like. You make tofu with some chicken, it's going to taste like chicken. And so that's kind of what the euro is. The euro is just kind of a counterparty to complete a currency pair. The pound is stuck in, the pound is kind of in this period of lost decades stuff, right? They've just gone into this downward spiral of Brexit and trying to work that out. And so then we have this pound currency that is so tough to even get a feel for that it's not even on this. It's not even on this radar. And the US dollar has gotten very much out of sync with the correlations as well, right? And this will happen, and this is something that we need to be able to identify. Sometimes the Aussie and the New Zealand are not going to be the most tightly correlated to this risk on, risk off market. Sometimes it'll be the dollar and the CAD or something along those lines, right? And so we need to be able to use these principles and look at the charts, right? We have to say, how is the reaction working right now? What is happening right now? And it's not going to change constantly, but it will change, right? It will change. This is pretty steady and pretty consistent, right? Swiss franc and Japanese yen. The Swiss franc has always been a safe haven currency, and so is the Japanese yen. When volatility spikes, Swiss franc strengthens pretty immediately. When the stock market takes big dips, the Japanese yen strengthens pretty immediately, and those two tend to happen fairly close to each other. So these are pretty well bunched in there. Japanese yen has almost always been a really safe haven kind of currency, and the Swiss franc as well, and they've stayed very consistent. But again, you know, the Aussie dollar, the New Zealand dollar, you know, it'll swap out with US dollar sometimes, and with you know, the Canadian dollar, and I don't know if the euro is ever going to come back into the mix, but we'll watch for it. But, you know, we've just got to look at the charts, and we've got to be able to kind of see how this all plays out. Okay, questions, comments. We're headed over to the charts now. Is everybody feeling good about what we have covered thus far? Any questions? Any comments? Everyone feeling pretty good, pretty good? Please let me know. I want to make sure I don't miss a thing. Glad to have many of you with us here. I've got, I see some familiar names and some not familiar names, which makes me even more excited. I love having new people on with us, so great to see you guys. Okay, let's get Bob feeling warm and fuzzy. I like it. I like it. Warm and fuzzy is good. So here are some of the best opportunities that I think are going to be happening over the next several months. Sassy, why are they safe haven currencies? It's a good question. Why the Swiss franc and the Japanese yen are safe haven currencies. And it's, you know, it's for a lot of reasons, but for the most part, with the exception of a few little moments in history here and there, the Japanese economy, the Japanese central bank, Bank of Japan, the Japanese currency, and so on, very, very stable, right? We don't see anything happen there. Interest rates have been near zero for years and years and years. And so we don't really see much going on there, right? It's just very stable. And they're not really susceptible so much to too much happening. And the same thing with Switzerland, right? Switzerland's kind of this real neutral place, and Switzerland's always kind of had that element of, you know, keep your money, put your money here, keep your money here, kind of a thing. And their economies stayed very, very stable over the long haul as well, with the exception of the Swiss franc. Forgetting to mention that they were going to have a major change in interest rates and causing massive movements in Swiss pairs. They've just stayed very, very stable. So they're always kind of easy places to flow to when things start to become not so safe feeling, you know, in the rest of the markets. But, you know, in the US, we see all kinds of crazy political stuff going on. We see the same thing in the UK happening. We see, you know, Europe can't really kind of come together on a lot of different things, you know, so there's all these other countries, you know, Australia, New Zealand are smaller economies, and they are more susceptible to what the larger economies are kind of doing. And so that's why, you know, that's why we've got those safe havens that just kind of sit and stay stable. And speaking of those safe haven currencies, I think we have some really, really great opportunities coming up, and we're going to talk about those. But let's go over here for just a moment and look at some of these charts we've been discussing, like the VIX and like some of these other ones. So remember, the VIX is just VIX. I use the CBOE VIX. So I like to have the two numbers after the decimal point. There's two VIX on here that you can look at on TradingView. One is just a single decimal or just a single digit after the decimal, and the other one is this one. But they both will tell you about the same thing. Actually, let's double check. This one, 12.7, 12.7. Yeah. So right at the same. Okay, so this is our volatility index. This is telling us that currently we're at low levels, right? And this is where we're going back to that technical analysis, and we're saying we've got to look at trends, we've got to look at channels, patterns, support, and resistance. Those four things are going to be super crucial. And we're not going to have a trend on the VIX, right? It's either going to be high or it's going to be low. So the VIX stays very flat. It's just these are points of volatility, right? Major points of volatility. I think this is probably when the Swiss franc made its big move, and we saw the VIX make a huge run up there. And then, of course, we have 2008, where the VIX ran up to almost 100, sitting at 12.7 right now. The VIX ran up to 100. Just kind of give you a little bit of an idea of the math. That's kind of like your blood pressure being 1,000 over 200. It's pretty darn close to breaking the whole thing apart. So we saw the VIX make some big runs up here, but for the most part, you know, when the stock market, and we've had this very, very stable bullish run, right? The stock market's been going up for 10 years. 10 years. Of course, there's been some consolidation and so on in there, but these are the bumps in the road that the stock market has faced and felt and had. And you know, we can see some of the very recent ones. This was beginning of 2018. We kind of had that February freak out, which is probably the best term here, where the VIX shot up to 50. That was massive. And, you know, beginning of 2018 was quite wild. But so was the end of 2018. We saw that big sell-off at the end of 2018, September, October, spike in volatility, spike, and ultimately giving us its highest point here in the end of December, when the stock market took a pretty big dip and we saw a big turnaround December 26th, and the S&P and Dow and everything kind of made this massive comeback. That's a big question, Bob. How the VIX is calculated? Volatility is an interesting thing. I would recommend, if anybody wants to know more about the VIX, because we won't discuss that too much today. But if you want to know more about the VIX and how it's calculated, just search volatility. Go to Investopedia and just do some research on volatility. Basically, the size of movements, right? This is the volatility on the S&P. This is giving us kind of the size of movements over certain periods and calculating that forward. But it's a little intense. So definitely go have a look at that in Investopedia. It'll be good stuff. So we see these kinds of movements. So what happens every time the VIX gets down to these low levels, especially since about 2018? The VIX gets down here and it runs up. So the last 2 years, it kind of hits this 11 and a half level, and it shoots up, right? Shoots up a little bit, shoots up a lot. It comes all the way back down, back up again, and here we are. This is where we're trying to look for some of those trading opportunities, right? We're saying, hey, first and foremost, we've got a couple of missed pivots up here. You know, for those of you that have seen how I trade missed pivots, it's pretty important stuff. So we've got some missed pivots up here, but most important, we have this VIX that's sitting down here at this low, right? And so I look at that and I think, okay, the VIX is sitting at this major low level. It's got to come up probably sooner than later, because what happens? We hit and it spikes. We hit and it spikes, right? And here we've hit and it hasn't spiked yet. Now, this is why I just love good old technical analysis, right? Because we can look at these levels and we can say, well, this has kind of been the last 2 years of what the VIX has done, right? But we've also got, kind of our lowest levels, probably the lowest levels that I think this is kind of our historic lows. The VIX will not probably in anyone's lifetime here get too much lower than about that 9 that 9 level, right? This takes us all the way back. We're going back to before I was born. This is 1990 here. So it wasn't quite before I was born, but it's right there. So that's the lowest level that this VIX gets to, right? So we're sitting here at 12, 12 and a half. We've kind of hit this 11 and a half area. The lowest it goes is about 9 and a half. Yeah, it'll get down to 9, but it's right around these lows, right? What I try to teach and what I try to preach here in a major way is the absolute importance of finding channels and finding support and resistance. And the safest thing that we can do is we can try to get bullish at ultra long-term lows and try to get bearish at ultra long-term highs. Everybody with me on that? Everybody with me on that? You guys, now it's different in stocks a little bit, right? A stock can trend up forever, right? And we've seen that kind of thing happen. I mean, just a fantastic little example right here. Look at Apple, right? So we're not going to say, hey, let's get bearish at some of these highs up here because Apple's in a big uptrend and it's going nuts, right? Stocks are different from currencies. A currency we could not sit and watch, USD go weak forever against the euro. What does the euro look like? Is that our euro thing? There we go. So we couldn't watch the euro get weak against the USD or vice versa forever because that would cause a massive imbalance and it would just be unsustainable. And one economy would literally have to just cease to exist, right? But in stocks, that's not the case. But we're talking about currencies here, and currencies are kind of much more like the actual VIX itself. So as we look at this VIX and we see that it's at these big long-term low levels, in my humblest opinion, our safest bet is going to be to look for a little bit of volatility to come, right? We've got, this can run lower. This can definitely run lower. But as we kind of reach these 2-year lows, I think it's safe to say we've got a little bit of volatility coming. I'm not calling any kind of stock market crash. I'm not saying that there's any, that it's time to get bearish the stock market, but I think we could see some volatility, and volatility is going to create some trading opportunities for us. So as we sit down at this low level here, I'm looking for the VIX to make its way higher. And I want to position myself in such a way that I can benefit when and if the VIX does run up. And the VIX always runs up, right? It hits these lows and it runs up. Now, what can tell us, if we're sticking with that technical analysis, what can tell us that this VIX might be ready to pop up, right? Well, we want to go over to the S&P because the S&P is specifically what the VIX measures, the volatility in the S&P. So if I go over here to the S&P and I say, all right, and again, we're talking about using these charts to find currency trading opportunities. Well, the VIX is sitting at a pretty long-term low, and it doesn't typically get too much lower than it is right now. So what do we do? What do we do? Well, in this kind of an opportunity here, I look at another corresponding chart like the S&P, and I say, okay, S&P, this thing's at all-time highs, right? We're at all-time highs on the S&P. We're just a hair below all-time highs, but it's hard to say where the highest point is, right? Where are we? Is this at highs and it's ready to turn down? We never know. An S&P could continue running for a fair amount of time. But what I'm looking at here is I'm thinking, here's a pretty well-established 10-year channel, right? Here's our 10-year channel. There's our 2009 low. And this is at the top of that channel. So is it so coincidental that the S&P is at a 10-year channel high and that the VIX is at 2-year lows and not too far from all-time lows? So now we're starting to kind of formulate something here, right? So we've got these two charts. This is saying, probably ready sooner than later to run up a little bit. And this is saying, I'm starting to hit some of these highs. We've seen a little bit of bearish movement here. Yeah, and I'm not calling for some kind of big, massive correction, but I do think that looking at this chart and kind of the short-term and kind of the long-term channels, there's that long-term channel that we've been hitting the top of right here. And here is a little bit more of a shorter-term channel. And I look at that and I think to myself, that's pretty interesting looking, because now the last year, the last solid year, the S&P's been bumping along here, and it's still right in that major resistance point. Think technical analysis, right? We're right at the top of that short-term channel high and that long-term channel high. So what's that telling us over here? Well, if we go back to the good old technical analysis, here are bonds, right? This is our ETF that tracks our bonds, and this kind of tells us a little bit of what is going on. And it's no coincidence that bonds came back down and hit this 1 year trend channel low. They also hit this past resistance turn support and have bounced off that. So while the S&P has been pushing higher and the VIX is staying lower, we're seeing some early signals here that there's lack of confidence, right? That bonds are starting to go up, and there's a little bit of fear and lack of confidence in the stock market. Again, how is this going to play out with our currency trades? We're going to look at that. So along with that, we're seeing some early signs. This is not showing that yet, but this over here, volatility staying low, S&P stock market staying high, but bonds are starting to come up, right? And remember, bonds will go pretty opposite of what the stock market is doing. So these have been coming up, and we can look at 10-year yields and so on, and you can see coming down, 30-year yields coming down. Everything's coming down, bearish, bearish, bearish. Bonds are going up, yields are going down. So we're getting possibly an early sign here that, you know, that there is a little bit of lack in sustainable confidence in what the market is doing. It's been running up nicely, and investors are showing that our investor sentiment is, it's still okay because the VIX is low, but slowly we're seeing that shift over into bonds. So yields are coming down because there's a high demand for bond. So they're saying, hey, we're not going to pay you so much because you're going to buy these bonds anyways. Now, keep in mind, just strictly bonds, there is the element of foreign money that buys bonds as well. And so that can kind of help bolster bonds up just a bit, right? There's a lot of, you know, Switzerland, for example, is a country that has negative interest rates, and there's other countries that have negative interest rates. And so, you know, there is that element of negative investments moving into a positive environment like US bonds and treasuries. But for the most part, for this intent and purpose here, we're seeing that there is definitely something on the horizon, right? So how is that going to play out? Now, remember, if we go over here to these charts and we look at this, how's that going to play out on some of these main pairs that have been most heavily correlated this year? Swiss franc, Japanese yen, Australian dollar, New Zealand dollar. Well, if I know, here's the Japanese yen versus the New Zealand dollar, for example. If I know that the stock market is starting to show some signs of instability, what do I want to do with this New Zealand yen? If I know that a risk-off market, if the stock market starts to take a little bit of a dive, I know that the New Zealand will weaken and the yen is likely to strengthen, right? So then what's going to happen to this New Zealand yen? Probably we're going to see a little bit of a move lower. We're going to see this thing make that kind of a dip there. But what I want to look for and what I want to be aware of is, that's great. If this dips lower, then I want to look for, because here's my take. We still have a very strong uptrend. We're very much away from, you know, the stock market's not really sideways and it's not really trending down. Investor sentiment is still strong. And if it takes a breather at this point, just speaking technical analysis wise, if it takes a breather, we still have a fairly sustainable uptrend. And so I want to stick with an investor sentiment that is strong, that might take some little dips and some little breaks, because all those things are still in uptrends. Are you guys with me? Is this making sense so far? So if that happens, I'm looking for this to drive this Japanese yen a little bit stronger and drive the New Zealand dollar a little bit lower. right? That's going to cause this to run down, but it's going to cause this to run down into a major consolidation area that was very strong and holding from 2009 to 2012. So we could get that one more push down there. If we get that spike in volatility, we could get that one more push down. And it might be, here we're trading at about 69.60. We might get this down into 65, 6,600, at which point I would be very anxious to start jumping in and trading this higher, right? So I'm just saying, as far as technical analysis goes, this thing has been coming down very steadily since 2014. It's been working its way down. New Zealand dollar's just been getting hammered. And it's starting to show signs of solidifying, right? It's showing some signs here. We've got this massive 5-year falling wedge. And so I think that we have got ourselves a very, very excellent opportunity. We'll just say 65, 6,600 to start buying the Japanese, or excuse me, the New Zealand yen. So this is kind of what I'm going to be looking for. Now, that's gonna be a little bit kind of on the long term, right? You're thinking, okay, this has to drop 300 pips before I can even do anything with it. 300 pips could happen in 5 minutes of the VIX spiking up and becoming volatile. So I really like the Japanese yen, but I'm very aware that the VIX is low and the stock market's high, and bonds are already starting to show us signs that investor sentiment is shifting a little bit to the safer investments. And we know that that risk-off safer investment market is going to mean Japanese yen strength. So I'm going to look at these levels, but I think we have a really great opportunity to see this kind of thing happen right. Hold on, let's get rid of that little guy. I think we could see this kind of thing happen where we get a little dip, little pullback, one final dip, and then that is the movement that I'm looking for. That kind of big movement here. And this is how we're going to stay on the right side of these big movements. Do we want to short the New Zealand yen? We could. And it could be a nice little short-term, sell trade that we jump in here with, and we say, okay, here's a decent little channel that I think we could trade because, if we get that spike in volatility, this could absolutely make a little bit of a dip, right? We could see this thing run down, 1 to 2 to 300 pips from a breakout, and that's great, right? And technically speaking, we have, we've got a little bit of a rising wedge here, and this could very much help this this New Zealand yen sell off and make its way lower. So I'm open to that. But the big movements that we want to be on, the big stuff where we can get, 400, 500, 600 pips, 800 pips out of a movement is by waiting for that volatility to spike, getting this thing lower down into some of these key crucial levels and buying the heck out of it and holding on to it till, if we could trade this from 6,600, let's say, back up into some of this major consolidation here, that's 1,000 pips, right? And so that's how we get into these kinds of movements. As we look at that real big picture, I'm on the weekly chart, but I'm timing my entry as best I can. We can't time markets perfectly, but I'm timing my entry as best I can by saying the VIX is low, and when the VIX gets really low, it spikes up. And when the VIX spikes up, the stock market comes down. And when the stock market comes down, the Japanese yen strengthens. And if that happens, then we'll see this New Zealand yen come down. So yes, I believe there's probably a short-term 1 to 300 pip trading opportunity down on the New Zealand yen. But from there, I think there's a, on the very, very low end, 500 to 1,000 pip trading opportunity higher on New Zealand yen. Does that make sense? You guys with me on that? Can you see the logic and can you see the everything that we're looking for? Now, remember, I've done other webinars on some of my strategy and some of the things that I look at and how I put together my ideas. And it's more than just here's a support and resistance level and here's the VIX. We have to have good targets. I love market imbalances. I love pivot points. I love all this stuff. We have missed pivot points galore on this one. And we have market imbalances, meaning that there was aggressive runs down that never corrected, aggressive runs down, aggressive runs that never corrected. So this creates market imbalances, which are very high probability targets. So we've got high probability targets above, we've got major support below, and we've got the absolute correlation and support of the VIX, the S&P, bonds, and yields on our side as well. Make sense, guys? Any questions, any comments on that? I'll move on to the next one. So Japanese yen, and guys, I'm going to post this chart along with many of the other charts that we have talked about that we'll talk about today. I'm going to post this with the webinar recording so you can review that and look in there and grab some of that. Okay, you guys still with me? Everything making sense? Everyone's still alive and kicking out there? Because there's a few more really excellent charts that I want to go through. I want to make sure I don't leave any questions unanswered. Sese, I think that's sense. Oh, there we go. Good. All right. So New Zealand yen, great opportunity. I think New Zealand Swiss is a great opportunity as well. So I'm looking at New Zealand pairs. New Zealand Swiss only goes back so far, right? Most charts only take New Zealand Swiss back 10 years. There are some that go back a bit further, but it kind of goes back this 10-year chunk. So New Zealand Swiss has had very erratic, wild spikes into this big low over here that takes it a few hundred pips lower than kind of this little double bottom, right? We get these spikes. We had a little bit of a longer period over here in 2009, for obvious reasons, because, as we talked about, Swiss franc will strengthen when volatility is high, when the stock market panics. And the stock market panicked, and it ran all the way down here and created that massive low on the New Zealand Swiss. But then we've had, big panicky movements since, right? We've had the Swiss National Bank movement, which actually was probably this guy right here. We've had other kind of high volatility movements. But I like this New Zealand Swiss because as we're looking at, once again, this takes us into about a 5-year channel. Anytime we can find really long-term highs and really long-term lows, I really like that. And so I really like the New Zealand Swiss a little bit lower than where it is. I want to see this thing run a little bit lower, but as it happens, it's pushing a little bit higher right now. But as I see, once again, with the VIX and with the S&P and with everything kind of positioned the way that it is, I think that this is a fantastic opportunity to get a spike in volatility and get this New Zealand Swiss down closer to about 61, 6,200. We're sitting at about 63.90. If we can get this down about 200 pips, right? And again, if there's any kind of spike in volatility, a 200 pip move lower on the New Zealand Swiss will be a piece of cake, But from there, I want to be aggressively bullish, right? The New Zealand Swiss has popped from basically 6,100 down to about 57.50 a couple of times, right? And it does it with these long, wild wicks, but it's not common movement for this pair. So I think we're pretty safe staying above 6,000 here. We've got some really good, it's a good psychological level. We've got some good levels of support here. And so this is a great area for us to be looking to get long and buy the New Zealand Swiss. So again, we need that little spike in volatility. We need the VIX to come up. We need the Dow and the S&P to come down. We need bonds to keep pushing like they're pushing. And that's going to do this. And from here, we're going to do this. We've got tons of great targets up here. We've got this beautiful channel high that's up here around 72, 7,300. So if we can get into this thing around 6,200, 61, 6,200, somewhere in that general area, we've got potentially 1,000 pips to work with. And that's what I want to see. So I'm looking to buy this one 6,100, 6,200 for the long haul. I want to see this puppy run all the way up there and get into that 7,000, nice, good psychological level, 7,000. This is 7,000 right here. But we get it up into that 72, 73, and we've got ourselves a massive trade. So this is a trade this is a longer term trade. It'll take a little time to play out. It'll take a little time to fill it, a little time to work its way up there. The strategy I use in my trade group is I start my position small, and if the trade goes against me, I add a larger position. But I only do that when I'm very, very, very confident in the long-term picture. And I am very confident in this longer-term picture. What do you guys think? So we've got New Zealand yen and New Zealand Swiss that need to both drop, not a ton, you know, 1 to 200 pips would start to get things very, very interesting. And then I am looking to just start adding buy positions and build a big, fantastic trade that might consist of 3 or 4 or 5 positions. I may start small. I will always start small. And then I add a little bit bigger, and I add a little bit bigger, and I add a little bit bigger. And so that's the kind of thing that that we're going to be looking for. Does that make sense, guys? New Zealand Swiss, New Zealand yen. You guys with me? You see the charts? Any thoughts? Everything good there? All right, all right, all right. Very good. Want to make sure I don't leave anybody out. Okay. Bob, Alan. We've got a couple of everyone in there. Dennis, you feeling good? Dorothy, Dave, you feeling good? Greg, Jack, Joseph, everyone, you guys okay? Everyone hanging in there with us here. Good. Harold, hopefully you're doing all right. Good. Thanks, Wade. Thanks. Strategy works well. We make a lot of positive trades in the group. So like about 90+% of our trades are positive. So it tends to work well. Chris, I have no idea what the turn in the VIX will do for the pound pairs. Probably nothing, because the pound is totally on its own. It's got Brexit, and so volatility doesn't matter, interest rates don't matter, employment doesn't matter. Brexit is all that matters. So that's why I'm not trading pound pairs, and I haven't traded pound pairs in probably 2 or 3 years. Just steering clear. Just steering clear. Okay, so New Zealand Swiss, New Zealand yen, 2 great trading opportunities. Thanks, Dorothy. Good, good. Learning something and ready to make some cash. I love it. So this is going to be a great one. New Zealand Swiss, New Zealand yen. I like the New Zealand dollar as well. I think that this is going to be a very, very good one, because once again, the New Zealand, even though the dollar is a little wishy-washy, right? The US dollar is a little wishy-washy. If we see things really make, you know, a dip, right? We see that risk-off market happen, and the New Zealand weakens. That's actually really what I want to see on this New Zealand dollar. I want to see this thing pull back just a little bit. I'd like to see the New Zealand dollar, honestly, pull back 100 pips. That's all I want to see. If I can get this from 64 to 63, I think that's a great trading opportunity for the New Zealand dollar. Get it down here, and then I'll be trading this thing up to at least 66, 6,700. So again, 300 to 400 pips on the low end. But most likely, I think we can get this back up into the 7,000 area, which would be a nice 700 pip run. So this has got the dollar element, and the dollar element's a little less correlated with the markets as of late. But I really, really love this because one of the main reasons is the New Zealand dollar US dollar has hit this basically 6,200 for 10 years and hasn't been able to push through it. Now, trends end and support and resistance levels break, right? But if we see that volatility spikes and it causes our New Zealand dollar trade, our New Zealand dollar pair here to dip down and retest that 6,200, anything below 6,200, if this thing really starts to try to take out 6,200, then we can kill the trade, right? We can say, whoop, we're wrong about it. But if we can get into this thing at 6,300 and have 100 pips worth of risk with 600 or 700 pips worth of profit potential, you think that's worth it? I think it's worth it. So New Zealand dollar, US dollar, 6,300. This is one I love. This is one I love. So I want to buy at 6,300 on this New Zealand dollar. Again, I'm a huge fan of managing my risk, right? I'll scale into some positions between 63 and 62, keep my risk very manageable. The thing that that I have the most trouble with is when I hear people say, you know, place a 50 pip stop loss, a 25 pip stop loss, and so on. This is a big moving market, and there's no point in trying to get it right within 25 or 30 or 40 pips. We need to give the market room to breathe. So that's why I give my trades 100, 150 plus pips, because and I scale in positions. I break up my normal trade size into 2 or 3 or 4 positions so that I can give the market plenty of room to breathe, because that's what it needs. So we've got a big long-term trade here on New Zealand dollar, US dollar 6,300 for a profit potential of, you know, really 500 to 700 pips is really where I think this New Zealand dollar is headed. So New Zealand dollar, New Zealand yen, New Zealand Swiss, and New Zealand CAD. So we've got this New Zealand CAD as well, guys. This is giving us the same kind of opportunity here. Look at these levels. Support level since 2013. Big major support level down here as well. All the way down to the 8,000 level, right? So, you know, round numbers are always interesting. But this level is held all the way back since 2013, and this is about 8,250, and we're at about 8,500. So we get a little bit closer to that 8,250. I think that this is going to be a good buying opportunity, and I think we're going to have some good chances. We have a nice rounded bottom right there. If this thing can pull back into 84, 83.50, I'm going to start buying this. So I like this area. Buy at 83.50 to 8,400. And what am I targeting on this son of a gun here? I want to see this thing run up to, at the very least, I think this consolidation zone and this monthly pivot up here is a minimum target, 87.50-ish area. So we should be able to get anywhere from 300 to 400 pips out of this. But I think there's a very high likelihood that we're ready to head into some of these bigger upper targets. So 300 to 400 pips, and you know, upwards of 500 or 600 if this can, you know, hold on to that momentum. And how are we going to know if it's holding on to that momentum? We're going to be over here. We're going to be looking at these charts. We're going to say, okay, is our VIX up? Is it down? Is the VIX high and this thing is still kind of hanging in here a little bit, right? If we're looking at any of these New Zealand pairs, we see that the VIX is already high and they seem to be holding on for dear life. The VIX only goes up for short periods of time and then it comes back down. In the last 2 years, we've had some wild and crazy spikes, but that lasted for, this is a daily chart, that lasted for a week, right? This lasted for a day. This lasted for 2 or 3 days. This lasted, you know, about a week. So we get these high spikes in volatility, and it usually comes down fairly quickly, right? And as this comes down, everything gets right back into normal again. So we're going to really be watching these charts and making sure that we're seeing, you know, where is that sentiment? Where are our bonds and yields going? Where is, you know, the stock market? Where is volatility going? And that's going to help us to understand how long we need to stay in these trades and you know, and kind of the element of where the momentum is actually starting to slow and even turning. So I'll post these charts, guys, with the email that's coming up. New Zealand dollar, New Zealand yen, New Zealand Swiss, New Zealand CAD. I'm right on the same boat here with Aussie pairs, because if we get that risk kind of off movement, that's going to drive this Aussie down and this yen towards strength. But look at the Aussie yen. Have you guys looked at this chart right here lately? Aussie yen has come off 10-year support multiple times here. 2009, we hit, and it's coming off that level again. We've got great upper targets on this Aussie yen. And we've got a couple of lower targets as well. And what do we have right here? The good old patterns that we look for. And it's going to be interesting to see, is that the pattern, or is it going to be something a little more like, whoopsie, hold on, my mouse got a little out of control. So we could see this kind of running up and create a big right shoulder before continuing higher. So either way, I think we have a nice head and shoulders pattern somewhere coming in this region as it trades against 10-year support. Look where we're trading, 73.70. This 10-year support's really kind of around 7,100. So again, we get this down 1 to 200 pips, and I'm really excited about it. And even if we don't, if volatility just kind of stays where it is and we get this nice pattern neckline breakout, then let's start trading it towards missed weekly pivot, missed weekly pivot, missed monthly pivot, missed weekly pivot, market imbalances. We've got great targets up here towards the 80 level. Here we are at 7,300. I think we can get this down a little bit closer. 7,370. I think we can get this a little bit closer into the mid 72s. And from there, we can scale in some positions against these lows and we can target these bigger upper levels. But we're waiting for that. You know, at this point, I'm very much waiting for that next spike in volatility to drive these pairs back towards support, a little bit closer to those levels, and then we'll start trading the heck out of these things back up towards these large targets. November and December are big trending months. Big things happen this time of year, and then you know, the first week of the new year can be a little bit slow, but then January, February, March, April, May. Just starts cranking again, and it runs everything right into kind of the pre-summer movements. So that's what we're looking for. That's what we're looking for. So I like this down in the 72s. Aussie yen buying at around 72.50s, give or take. Now, at the time of entry, it might vary a little bit. I might end up getting in at 72, might end up getting in at 73, just kind of depending on how the chart looks. But that's kind of the area that I'm looking for right now. So if you wanted to just kind of jump on this and you said, you know what, this guy might be crazy, but I'm going to give it a shot. And I'm going to put a little trade on, and you put $1 a pip in there and you forget about it. You should make some good money on that. Yeah, that's right. That's right, Sharon. We had a big spike early January, and I've seen some Januaries very active. Yeah, you're absolutely right. So we could see some stuff. We could see some stuff. How did our, let's see. Here was our, yeah, you're right. This was January 2nd, that massive spike. And awesome move. Awesome, very awesome move. So I like that one. I'm a huge fan of this one. In fact, I'm already in this trade in my trade group. But Aussie Swiss. If you look, we've had a double bottom at all-time lows. That's a pretty good thing usually, right? Double bottom and all-time lows. Last time we hit this low was 2015. Then we hit it again in August-ish when we had a big spike in volatility, right? The VIX shot way high. Interest rates went really crazy. Stock market took a big hit, and the Aussie Swiss made a run down into that double bottom low. And here it is. Here it is. So I'm already in this trade, but for those of you that might be wanting to participate in here, we have a great channel to trade here. And if we get that spike in volatility, which is what we want, spike in volatility, that's going to drive this Aussie Swiss down probably another 100 pips. If I can get this Aussie Swiss down into 66.50, I'm going to throw another position on. So 6,700, 66.50 is a great spot to buy this Aussie New Zealand, or excuse me, this Aussie Swiss. And we've got some really, really good targets to go trade after up here. Nice missed pivots, 7,000. So again, you know, if you just grab the 300, 350 pips, that's okay too. 7,100 and thereabouts, 7,200. These are great spots. So I really like buying this Aussie Swiss at 60, we'll say 66.50 to 6,700 is where I think we have a great opportunity to kind of buy this pair and trade it up. So right in that general area, I think it's good for, you know, 300 to 500 pips. Aussie CAD, same kind of situation here, right? We got this risk on, risk off situation going. We get that spike in volatility. All these Aussie pairs are going to come down. All these New Zealand pairs are going to come down, but they're coming down into very long-term support levels, and they're running away from massive high probability targets. And they've all got very nice bottoming out patterns. This is where I think the best opportunities are going to be, is on the New Zealand and the Australian pairs, buying big dips. So I like this. I like this Aussie CAD. Already in the Aussie CAD actually, but for those that kind of want to participate here, you know, anywhere from 8,900 to 9,000, I think is a great spot. But since we're looking for that spike in volatility, and you know, since you won't have the necessarily the guidance of my day-to-day trade recommendations, give it 100 pips. Let this drop down into 8,900, and then take it from there. So we've got a lot of great things to trade, a lot of great setups in the works, and I'm very excited. I'm in some of these already, and I'm planning on getting into the rest of them as we get that confirmation over here, as we start to get these things happening, right? We get that VIX up a little bit, we get that S&P down a little bit, we get that follow through on those bonds. That's telling me that we're close to an entry. We're really close to an entry. Does that make sense, guys? How do you guys feel about that? Does anybody have any questions, comments? What do you guys think? Seem okay? Sound okay? These are definitely what I think are going to be the biggest, best trading opportunities of the next, you know, probably the next year, probably taking us into the end of next year. And if we just get 1 or 2 entries on each of these, it won't be too difficult to make several thousand pips, right? And what I want to do, and what I specialize in doing, is just try to make the most amount of money with the least amount of risk and the least amount of effort. That's always nice too. Get in these trades, let them sit, make the money, let them play out. That's what I like to see. That's how I like to see these trades work their way through. So that's what we're looking for, and these are some of my best trading opportunities. Like I said, there's more to just there's more than just getting in these trades and sitting in these trades, because it gets hard. It gets tough to just get in a trade and sit in a trade, and then you end up, you know, you make 1/10 of the big movement, and then you're out, right? Because people think it's ridiculous to sit in a trade more than a day or two, or mentally it gets too challenging, or your trade size isn't good, or you don't feel like your entry was very good. A lot of things can happen. And for that reason, if you want to jump on board and make the big trades that we're going to make, if you want to get on with these big movements, this is the time to get hooked up with my Day Traders FX Premium Live Trade Group. We are going to trade all of these. We're in half of these trades already, and we're going to get in the other half, and we will make 5,000 to 10,000 pips from just the trades that I have talked about with you guys this morning. So remember, we do this by having 2 live weekly webinars. I did a live webinar with the trade group this morning. We talked everything trading. We talked about what we did this week, how well we did, and what we need to improve on. And we're going to have another webinar Monday morning where we're going to talk about everything. We're going to lay out our goals for the week ahead. And every day we will pound on and update on these entries. I give trade recommendations and update those every single day during the week. The webinars are Monday and Friday. They start the week and we end the week with the webinars. But during the week, I post videos, specific trade alerts that are exact entries and exits, and how to manage a position. One thing that I love in the trade group is when I start to hear people say, gosh, I feel like this trade is really testing my patience. And I say, oh, you're doing it right. You're doing it right. We want to get these big movements, and to get these big movements, our patience is going to be tested a bit. So the trade group is there for support, and the recommendations are there for very clear instructions on how to implement everything that we have talked about today. So that's very good stuff. Along with that, for those that join in on this fantastic journey of catching these 5,000 to 10,000 pips worth of movements that we have coming up, I will also do a one-on-one session. I charge $500 an hour for one-on-one sessions that I do. And I will include that for those that join into the live trade group, because I want to make sure that we have a chance to analyze everything that you're talking about, thinking, doing, and so on, and help you understand what we are doing in the group. And it's very, very important. So this is all super good. Not to mention, we have countless traders from around the world that are hugely successful. I get success stories all day, every day. I'll be honest, we don't have a lot of traders in the group that are making millions of dollars, but I get messages day after day from people that have full-time jobs that say, I made $10,000 this month trading in the group with you. I made $15,000 this month. I made $20,000 this month. I made $5,000 this month. Somebody told me in the trade group, they said, I just can't seem to get ahead. I'm making $1,000 a month or so from your trade recommendations, and I have to keep pulling the money out because I need to use it for living. So I'm, and so this person actually just completed a year in the trade group, and they said, I'm just so bummed. I had to pull out, $11,000, $12,000 in profit this year just to kind of keep living and use it for my living expenses. And I said, that's fantastic. That's exactly the purpose of it. That's exactly the purpose of it. And so there's a lot of really great success stories. I have no interest in trying to pitch to everybody that you're going to be rich and that you're going to make millions from what I do. But I guarantee that you will be successful if you follow my recommendations. And we have many, many people in the group that can really help cement that and help make that work. So it's a really, really great group. And it's a really great opportunity to do something different, right? Because everybody's frustrated with their trading at one point or another. Everybody's frustrated with their financial situation at one point or another. And so the best, most important thing that we can do is something else, something different, right? If you're not having success as a trader, yesterday we talked about people that have been with us for 10 or people that have been trading for 10 years that have finally joined up in this group, and they're now starting to achieve some success, some profitability. So you have to do something different. You have to take a little bit of a leap of faith. But you guys most of you have attended many of my webinars now. You know that I am not a fly-by-night kind of person, and that what I say is what I do, and we are successful in our trade group. This is, I call this a free trade group because all of this that you get, right? 24 live weekly webinars, daily trade recommendations, international trade community of successful traders that I have built one by one, and one-on-one sessions with me. This is just about a 6,000. I mean, again, from my very frustrated group member that only made $12,000 last year being in the group from their small account and feeling frustrated about that. They made 12 times what the group cost to join, and most people make much more than that by following my trade recommendations. So it's one of those things where I say it's a free trade group because you pay $9.99 today, and you will make that money back in a worst case scenario. In a best case scenario, you'll make 10 or 100 times that amount of money. But in a worst case scenario, you'll make your money back. All I'm asking you is to trust me and to jump on these big, big movements that we've talked about, and to put to use my 20 years of trading experience. It's a little upfront investment, but it's something that will pay you back tenfold, 20-fold, 100-fold. So we'll have an opportunity. As I've mentioned many times before, you're not, nobody can just join the trade group on a regular basis. There's not an open enrollment. Whenever I do these webinars once or twice a year for the premium live trade group is when everybody can log in and join. And so you've got about another day and a half or so that you can join up in the group and jump on some of these 5,000 to 10,000 pips worth of movements that we have coming up. I think they're going to be huge, and I think they're going to be awesome. And I want you guys to join in with us and make it all happen. Good, Sharon. Good, excellent. Sharon's in the live group with us, working towards the big bucks, working towards the millions, but already made 6 figures. That's awesome, Sharon. That is super, super awesome. Congratulations. Good luck. Yes, and Sim's been with us for a lot of years. Very awesome, Sim. Yep, and had some very good profitable runs. That's super cool. Been in here. Yep, Bob, you've been in with us for the last year, and it's been a good experience for you. I know you've done really well and made some good profits, so that's super awesome, Bob. That's awesome. I'm glad to hear, guys. It's always good to see some good success stories. Somebody sent me a message today, and they said, I had some problems with both of my cars, my wife's car and my own car, and it was thousands of dollars to get both cars fixed. And he said, normally in the past, that would have been pretty hard to get over. That would have been pretty detrimental on the finances. And he said, now I was easily able to take that out of my trading account in profits, and it made no dent. It made no problem. And I thought, that's the good stuff. That's the good stuff that I love. I love that stuff. So, so lots of good success stories, guys. This is the group to be in if you are doing anything forex trading. This is the group, and it's not because I'm awesome. I do my best, and I try to give you guys the best material, but because we have very, very awesome group members, and we have great, great success in this group, and we have for years, and we will continue for years. And so this is one of those very few rare opportunities to join us. And again, there's about 24 hours left to jump in the group. I hope you guys will make the leap, come on in, and spend a year with us, changing your trading, changing your financial situation, and moving forward with your with enjoying life, because that's what we specialize in doing here. So thanks a bunch, everybody. If you have any questions, any comments, let me know. I will send this recording out in email. For the time being, you can head over to, where is it? You can, the link that I have posted, which is dtfx.co, join now, join/now. Yesterday's webinar is posted right here, right this moment. So yesterday's webinar can be seen right here. Let me send you guys this link. So you can watch yesterday's webinar here. This is also where you can get a little review of everything that we're offering, and you have a little bit of time to sign up and join the group here. Now, I want to make this accessible to as many as possible, and you know, if you have some great difficulties with the upfront cost, I have in the past for one or two people split the upfront cost into 2 payments. And so there are some options like that. I want to make it accessible for as many people as possible. So that's how, you know, we'll do what we can to make things work out for you. But best thing to do is just bite the bullet, go for it, get in here and get serious about your trading. And we're here to help, and we'll make it a great experience for you. Thanks, everybody. That's it for me. Questions, comments, let me know. I'll get this email put together. I'll get everything up and running and functioning here, and we'll take it from there. Thanks, guys. Nice to see you all. Take care, everybody.